Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 242 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark.
Not a whole lot going on recently over the past week. I feel like it's been pretty muted, which is interesting.
Yeah, I mean, we're 2/3 through Q1. We're past earnings season, got some quietness there, and we got the Fed meeting here in a week or so. We're kind of in this lull period, aren't we?
Yeah, I kind of like it being quiet and no major
Normal's
news,
good.
Which is good. Yeah, it's great.
As normal as it can be.
Yes, correct. As always, we will quickly review the month-to-date and year-to-date performance of the major indexes that we track. This data is from Y-Charts and as of the market close on March 6th. S&P 500 index is up 0.2% for the month and up 7% for the year. Dow Jones Industrial Average is down 0.9% for the month, up 2.6% for the year. The NASDAQ Composite Index down 0.4% for the month and up 6.8% for the year. The Russell 2000 Small Cap Index up 0.7% for the month and up 2.3% for the year. The Vanguard All World X United States ETF is up 1.7% for the month and up 3.2% for the year. 3-month Treasury rate at 5.47%, the 2-year Treasury rate at 4.55%, and the 10-year Treasury rate at 4.11%. No major headlines or current events from this week. Like we said, kind of earnings season for the majority is behind us. Have a couple stragglers reporting this week, but pretty much behind us for the most part. Moving on to tweets, articles, and research from this week. First thing I had, Matt, was a tweet from Wayne Whaley on February 23rd. Jenna will throw this up for YouTube viewers, and this will be in our show notes, but he says a 25-0 next year, March through February, when December, January, and February are each positive. So what this graph shows and what Wayne is saying is since 1930, the S&P 500 has been positive the next year in all 25 cases when December, January, and February were each positive for an average gain of 16%. And he also made the comment, quote, "Not sure the significance of such has had time to sink in, but of the 10,000s of scans I have performed in my lifetime, the December, January, and February barometer signal is the only 25-plus case study in my domain, perfect back to 1930.
That's big, and that's not a small data set.
Yeah, so again, we've talked about this. We've seen similar pieces of data like this pop up over the last couple of months. But it just aids to the thing that we always talk about is, strength tends to beget strength.
That's right.
Just because things have been good for the past, 3-4 months doesn't mean that the markets have to fall over the next 6 months.
That's right. And, the cynical side of me is just because it's 25-0 doesn't guarantee, obviously, that it's going to continue to be that case. It could be negative, obviously. But the reason I like highlighting these things is history could be a guideline at times. And I think it's good to at least know historically in these types of situations, what's the most likely outcome? And I think it's good to reference that.
Yeah, I agree. Second thing I had was a blog post from Michael Batnick on February 3rd titled, "Nothing is more bullish than all-time highs." So Michael says, "I'm skeptical at all-time highs. I know that feeling isn't unique to me. That's just human nature. It feels like it'll end badly. It feels unsustainable, but those are just feelings. At a blackjack table, I'm nervous to hit when I have a 15 and the dealer is showing a face card. but I do it because the data says to hit, and data trumps feelings 100% of the time. Human nature is unchanged over the last century. Fear and greed is fear and greed. We have talked about what happens when the market finally makes a new all-time high after going more than a year without making one. With the exception of 2007, returns were higher 1 year later 100% of the time. Investing is way too complex to be boiled down to a single variable, so no one is saying that all-time highs are when you should lever up, but having the knee-jerk reaction to sell them would be equally ill-advised. Getting back to the blackjack analogy, yeah, you might draw a 10 and bust, but that doesn't mean it was the wrong decision. Same thing with investing at an all-time high. Sure, the recent move might prove to be a head fake, but that would be a low probability event looking at the historical data.
Yeah, I think great analogy, and it makes sense to me.
And this is something that, I think is going to just continue to come up time after time after time, where people are like, well, I want to wait for a pullback before we invest. And it's like, okay, that's fine, but the market might run 20% more before we get a 5% pullback.
And I think these thought processes become more relevant the closer in proximity you are to a deeper recession that we just experienced. And think of the great financial crisis of 07, 08, and 09 and how long it took for the new high water mark to be made. Think of how bad 2022 was and how long it took to make a new high water mark. And I think that this thought process is more common the closer in proximity you are to those types of corrections, which statistically tend to be not common. And as we now go through maybe a period, this is not guaranteed, but if we go through a period where maybe the market makes a new high water mark, corrects, but then makes a new high water mark within the next 6 months, it might start to change that philosophy. Mm-hmm. But it's going to take a couple of years. And if you're an investor with a long-term time horizon, take advantage of that. Right. So I think that there's going to be opportunities throughout this year for people who are under-allocated to risk. You're going to get your chances at bat. The question is are you going to swing?
Yeah.
I can't answer that for people.
Right. And it's almost like a damned if you do, damned if you don't, because if you invest at all-time highs, then the market falls and you're like, oh, I shouldn't have done that. And the opposite side is if you don't invest, but the market continues on, you're like, oh, I missed the rally. So, a happy medium, even though the data says that we've gone over before on this podcast that it's better just to invest everything all at once over the long term. Mm-hmm. But a happy medium for people to deal with the psychology of it would be to dollar cost average over a certain period of time.
Well said, my friend.
If that makes you sleep at night.
Well said.
Last thing I had, Matt, is just a fun booze stat I found from the Distilled Spirits Council of the United States.
Well, too bad we're recording this podcast in the morning. We should have recorded this one post-market close, man.
I know. So, and we should have waited until April since for Lent I gave up alcohol this year. So it's been
good for you.
Almost a full month where I haven't had any booze. Feel great. A lot of energy.
I bet.
But it is nice to have a cocktail after market closes on Friday.
There you go.
Jenna will throw this up on the YouTube page, but this just shows the U.S. share of the global alcohol market going back to 2000. So it's pretty interesting, Matt. In this teal-ish line, you have beer, and in a blue line, you have spirits, gray line, you have wine. And in the early 2000s, beer was about 57%, had a 57% share of the global alcohol market. In the U.S., and spirits was under 30%. But you fast forward to today, spirits is now 42%, and beer has come down significantly, is at about 42%. And wine's just kind of stayed pretty stagnant. So it stayed roughly at 15-16% over the past 20 or so years. Mm-hmm. So I just thought this was interesting. And then also CNBC put a note in here and listed the top 5 spirits in the U.S. In 2023, and this was by revenue. So vodka brought in $7.2 billion, tequila and mezcal $6.5 billion, American whiskey $5.3 billion, cordials $2.9 billion, and then cocktails and ready-to-drink mixes $2.8 billion. So anything that surprises you here?
No, I mean, you just kind of see the trend over the past couple of decades. And I think it's a combination of people being more calorie conscious as they are consuming, beverages. I think that's one. And the other thing's cost.
Yeah.
If you go back to pre-pandemic, the liquor prices when you go to the liquor store are the same exact. There's been no inflation on the liquor front. And that is now a lot more appealing.
Right.
And I think that's a combination of those factors.
Yeah. So just thought it was interesting as I sit here waiting to have my first drink at the end of this month. So
I might be with you for that.
I'll turn it over to you.
All right. First thing, I want to remind our listeners and viewers, Mark, just about the bond market. Okay. I did this maybe several months ago. Things haven't changed much. So Charlie Bolello, a friend of our podcast, had this post on March 1st. He said the U.S. bond market has now been in a drawdown for 43 months, by far the longest bond bear market in history, Mark. Jenna's going to put up this chart for our YouTube viewers. This will be in our show notes for our traditional podcast listeners that they can tap into on any of our social media sites. Jenna puts up a post with all these notes. What you're going to see here very quickly is the closest period of a drawdown was 16 consecutive months, Mark, and you have to go back to the early 80s for that. So the maximum drawdown during the period was 17.2%. Now, I know early on in our early podcast years, I was previewing that bonds were in this bull market. People think they can't go down. And guess what we experienced? I didn't think we were going to experience the worst correction for bonds, but we did. The last chart I want Jenna to put up for our YouTube viewers is the Bloomberg U.S. Aggregate Bond Index. It's the old Lehman Brothers that got bought. It's drawdown going back to the data set to 1976.
Yeah, and for newer listeners, maybe who haven't heard us talk about drawdowns before, we're talking about, the point at which, bonds are at a high water mark to where the lowest point was that they fell.
Got it.
Yeah.
Perfectly well said. Thank you for that. And what you're going to notice here is from that high water mark that they made most recently in this 43-month downturn that Charlie's talking about, we are now down 11% from that high water mark. So the index has retraced from that worst point that you just described of 17.2%. It's right around 11 negative. So is it starting to claw back? It is. But heck, by the time it gets back to make a new high water mark, Mark, that could continue to take months and months.
Yeah.
So there's carnage out there still in the bond market. And it makes me wonder, like stocks became so out of favor after the great financial crisis, how long do you think it's going to take investors to trust bonds again after such a poor period?
Yeah, it's going to take some time. There's definitely going to be some trust issues there.
Yeah, and I think there's not enough talk about that.
Right, but I think it's going to provide some good buying opportunities in bonds because they're going to be so hated.
For years.
So, obviously, the Fed lowering interest rates will help bonds recover more quickly to that all-time high.
That's right.
Like we've talked about, a couple weeks ago, the Fed keeps kind of pushing that back. So
that's right. And a lot of these, if you look on the corporate side, a lot of these corporations refinanced bonds at pretty low rates during the low interest rate years. And the balance sheets, a lot of companies, a lot better than they have been in decades. So, could be some tailwinds on those bonds potentially. My next piece is a piece on the jobs market, and I'm really curious to see what your reaction is to this data. This was an X post by Michael Arway that I track on Twitter. He posted this on February 29th on the leap day. And what you're going to see by this chart is it shows the estimated excess retirees in the U.S. In essence, what you're seeing is the amount of people who are retiring at any given point. And the data set that he has goes back to 2000, and the subsource on this data set is the St. Louis Federal Reserve, okay? So Jenna will put up this chart for our YouTube viewers. This will be in our show notes. What you're going to see very quickly is the massive amount of people that retired right when the pandemic hit in 2020. You had that peak roughly about a year ago, and then it started to come down. And then you had, as the market recovered, another wave of retirees as probably their investments and portfolios recovered from the 2022 downturn. Okay, I'm comfortable to retire now. The reason I'm highlighting this, Mark, has to do with the jobs market. Because right now, if you kind of look at the economy's strong. You are starting to see some layoffs. I commented on that on the podcast about a month ago. Let's keep an eye on that. That's continued, some small layoffs from companies, but you really have seen a strong jobs market. And I bet you a direct contributory of that is the oversized amount of people who have retired recently. And it's leaving a lot of job vacancies in the market. And when you see such a dramatic chart like this, what's your response to that data?
Yeah, it's just definitely in a completely different environment than we have been in the past, 20 years, really. Because if you look back, all the way back to 2000, this chart goes, it's, hovered around that 500,000 on the high side to kind of negative 500,000 on the low side. And then it's like, it's looking at a price chart and getting a base breakout over a 20-year period. So maybe this is the new normal. Maybe you're going to have more and more people continue to retire earlier and earlier or sooner. But definitely something that's interesting to track. And it's even more interesting now that this number is skyrocketing as AI is getting brought to the forefront, right?
Yes.
So it's interesting to see if that has any correlation as well.
Absolutely. I think the last point I want to make just has to do with the good old demographics of the average worker, the baby boomers. And I think one could argue that just with demographics and just age of the baby boomers, that the amount of excess retirements compared to the last 20 years could continue to be above average.
Yeah.
Right?
Yeah.
All right. My next piece has to do with, and we talk a lot of stats about the market. This is from our good friend Seth Golden, who was on the podcast just recently. Seth had a really good piece, Mark, on March 1st I thought would be pertinent to share with our listeners and viewers. What he did is he shows when you have 4 straight months of gains like we had in excess of 20% or greater, what is the forward 10-month rate of return? Okay? So what you're going to see here is a data set of roughly a baker's dozen that fall into this category. And you want to guess really quick about the data? It ain't bearish. Mm-hmm. Okay? So very similar to a data set that you talked about at the top of the podcast, Seth here notes that the forward-looking return after 4 straight months of a gain of at least 20% for the S&P, it's positive 100% of the time for the data set, and the average return's over 15%. So yet another separate data set that is confirming that strength begets strength, and you might want to be careful about trying to call a short-term top in the market. That's my point I want to make on this.
Yeah, and I think it's even more encouraging now because you have the likes of, on a relative basis, Apple underperforming, Google underperforming.
There's not enough talk about what you're about to say.
Tesla underperforming, and those are big weights in the S&P 500, right? And for the longest time, the argument was, well, the top 10 names are just carrying this market further. Well, now you have Apple, Google, and Tesla struggling relative to the market, but the S&P 500 is up 7% year to date. So that's a good sign that we're getting this better or healthier market breadth, as we like to call it, of more stocks, smaller stocks participating in the upside, which is a good thing.
Yeah, and I think what this potentially sets us up for in the coming months and coming quarters is this kind of back and forth rotation. Maybe some of the recent high flyers take a breather, and then the money flows back into an Apple or a Google or some of the mega caps that have maybe a little more consistency in their earnings, and they kind of go back and forth. If that happened throughout the year, oh my goodness, this would be a great year for the indices.
Yeah, for sure.
So I have a bonus chart real quick. This is a chart from a Bank of America Global Research. It shows some similar data to what Seth was alluding to, but this time I'm highlighting what the biggest correction was during that year. So coming off of a really, really strong period like we just had, a lot of our listeners and viewers might be thinking, okay, I'm concerned that at some point we're going to have this massive downside correction this year. And with the data sets that we're seeing on a shorter term basis, forward looking, the average intra-year correction is somewhere around 7%. And of the worst of the data sets, and there's probably in this specific illustration about 20 or so, the worst intra-year correction was about 11%. I just want to throw that out there, that we are going to have corrections this year. We really haven't experienced much. And I'm not one that gets on the podcast and says this will happen. We are going to have corrections.
Right.
And I think that we just need to normalize the fact that when those happen, it goes back to what I said a couple of minutes ago. If you're under allocated to risk, the question is are you prepared to step up to the plate?
Right. Yeah,
that's my point.
Great point. Great point.
Send it back to you.
Last but not least, moving on to the financial planning topic of the week. This one, Matt, was an article from Alan Roth titled "The Law and Strategies to Convert a College 529 to a Roth," since that was a part of the Secure Act 2.0. There's a lot of questions on it, and as most things, when the IRS comes out with new language or new laws, or Congress passes new laws in regards to taxes.
Yep.
A lot of questions, a lot of ambiguity that I don't even think the IRS has the answers to right now. So
that's not a beer, everybody. That's my passion fruit sparkling juice for the record.
Unfortunately. So Alan says, beginning this year, the Secure Act 2.0 allows owners of 529 plans to convert unused 529 funds to the beneficiary's Roth IRA.
Okay.
But there are some stringent conditions, major ambiguities in the law, and potential income taxes and even penalties. I'll cover the law and tax implications, my experience converting some of my son's 529 money into his Roth, and some strategies this new law offers for college and beyond. Here are the details. The lifetime distribution limit is $35,000 per beneficiary, so you can only move $35,000 max from the 529 to the Roth.
Okay.
The maximum annual conversion amount is the IRS maximum for IRA contributions, which is currently $7,000 for those under age 50.
So you can't double dip. They
Correct.
can't be making a contributory and then also convert in the same year.
Yes, less any IRA contributions made to that beneficiary.
Didn't mean to cut you off on that. I was not reading what you were
So
go
if
over.
the beneficiary, for example, contributed $4,000 to his Roth, to his or her Roth IRA, they can only convert $3,000 in 2023. The 529 plan must be open for at least 15 years, so you can't skirt the laws by, opening a 529
dumping
for your
in 35
kid
grand
and dumping in 35 grand all in 1 year. The Roth IRA must be in the name of the beneficiary of the 529. That beneficiary must have earned income at least as much as the rollover amount. The rollover must be a direct rollover from the 529 plan to the Roth IRA custodian, i.e. trustee to trustee. So that money has to move right from the 529 right to the Roth. The beneficiary cannot take
no 60-day rollovers.
money. Yeah, no 60-day rollovers. You can't take that money, put it in your bank account, and then put it into the Roth. Contributions and earnings on those contributions to a 529 made in the last 5 years cannot be converted to the Roth. So that money has to be in there for longer than 5 years before you can convert it. And this kind of correlates to the Roth conversion rule, the 5-year window that starts for every conversion that you make, but that's for another day.
Yep.
So he says, while somewhat stringent, at first the law seems clear, yet this is far from reality. I spoke to Richard Ellis, executive director of the Morningstar My 529 plan in Utah, where I have an account, and I being Alan. He pointed out some of the ambiguities that need to be clarified by the IRS. Does the, quote, must be open for 15-year rule mean it has to be the same beneficiary?
Good question.
Does the, quote, must be open for 15-year rule include the time an account was opened at another plan if it was rolled over from another state? Can one change the beneficiary after the $35,000 has been distributed to somebody else or even themselves and start another $35,000 distribution from a Roth? can a beneficiary over age 50 make a catch-up contribution of $1,000 in addition to the $7,000? And I'm sure that there's a ton more scenarios that haven't been addressed by the IRS yet. So I'm not telling people not to do it, but just know that everything's not all hammered out per se on this topic. It is a great way for people to start saving for retirement early. I'm a huge advocate for this, but definitely some ambiguity here.
I love that you brought this to people's attention. This is wonderful.
Yeah. So, I'm like I said, a huge fan for this, but there's a lot of things that need to be figured out before, I'm assuming, the end of this year, so people can properly do their taxes. Right.
Well said.
So
yeah.
Before we head out, Matt, just want to let people know, if you want to create your own podcast, use the promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code Jessup Wealth, all lowercase and no spaces. With that being said, Matt, I just want to thank everybody for tuning in and listening to episode number 242 of the Independent Advisors Podcast. We will be back with you next week for episode number 243.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.